Hi, everyone, and welcome to episode 6 of the Derive High Signal podcast. Today, we're joined by a fascinating guest or a fascinating protocol that our fascinating guest is going to tell us about. So, a warm welcome to Ralf Taner. Hey, Ralf.
Hey Ian, hey Sean, how you doing?
Very well,
Going
thank you. How are
good.
you? How are you, Sean?
I'm going all right. Market's holding up somewhat. Little dump from yesterday, but we'll get through it. So could be worse.
Yeah, the reason I said kind of fascinating is I think it's interesting when you look at financial primitives and things we take for granted in TradFi, and a lot of that engineering still missing in crypto. And today, Ralph's joined us from Nexus Mutual, which could well be one of those primitives, could well be one of those pieces that we're kind of missing to have more sophisticated, capital finance infrastructure. So, really interested in the conversation. But Sean, I'll let you kick off the questions.
Yeah, like really just keen to hear about what an average day in the life of Ralf Taner at Nexus Mutual is like.
Yeah, wow. Just to say, I think this comes at a pretty timely moment to be having the pod here, guys. Like Sean and I think we met at Token 2049 out in Singapore, right? And that everything was rosy then. Everything was great. We hadn't had the balancer hack. We hadn't had 1010. We hadn't had stream finance. We hadn't had these sucky prices, but yeah, a lot of stuff. Like I was just a week or so ago in Buenos Aires for Dev Connect and was really surprised in a positive way. Even though it's because bad things have happened in the space. There's been losses, which is not good. People's attention has really sort of focused in on sort of risk rather than just yield and yield opportunities. So yeah, Nexus, we're around to help out in the worst case scenarios. So, a day in the life of Ralf Taner. That's an interesting one. But like it's pretty varied, and everything that's been going on past few weeks has meant that like versus maybe some more sort of strategic pieces that we've been doing. There's been a lot of like hands-on activity with the market, with some of the things that have been going on around people suffering losses and helping out our community to in that when things have gone wrong for them, so that they know that we're there for them and can help them out with the claims that they need to make with us.
If we look kind of, it's an interesting thing to even find Nexus Mutual. I just wondered kind of how did you find your way into that, and what was your kind of prior life before you got into crypto?
Oh, sure. Yeah, I mean, I've got a very nice entry into Nexus because I've got a really good friend of mine that is part of the Nexus team. So I've known about them for years. I've been with Nexus for just over a year now. I'm the head of business development, so I'm dealing with all things growth and franchise related, dealing with our clients and partnerships. But a quick bit on my background, I guess. Like I come from background of having a degree in computer science, a techie at heart. Though I grew up in the UK in London, and so pre 2000. I'm like you, Ian, because I listened to the early podcast. You talking about yourself sort of being one of the slightly older people in the industry. So I'm probably alongside you there. So I was around in TradFi markets before the Bitcoin white paper in 2008. So actually initially got into my career, started off as a software engineer at a bank in London, happened to be Barclays Capital at the time, and it's completely random. I just got placed with the commodities team. So that got me super interested in financial markets, where I'd never been interested in markets before, because it was very tangible, hands-on, things to do with real world, what everyone terms now real world assets, right? It kind of really got me interested. And then I sort of ended up winding my way down onto the trade floor, where at the time I didn't even know what a hedge fund was, but I ended up as the new guy on the hedge fund sales desk, and I was like, oh, I better get up to speed pretty quickly here. But I could do a couple of like bits of tech wizardry. I could pull a vol surface out of the system when these clunky old age tech systems, made it really hard for the sales guys to even like get a vol surface, for instance. So anyway, then had like several years in TradFi, ended up at JP Morgan, which is where I met a good friend of mine, Ricky, who is our chief operating officer at Nexus Mutual. So still in the TradFi thing at that point. Ended up exiting TradFi land, wanted to sort of just see what else was out there. And then around 2017 is when I kind of, a bit late to the party for a computer science guy, but got into crypto. And it was Ricky actually who was sort of like, listen, with your tech background, how are you not kind of diving into this a little bit more wholeheartedly? I wasn't drag kicking and screaming. I didn't dive down the rabbit hole. I was sort of like getting to know it. And I sort of, I guess, given what I'm doing nowadays with Nexus Mutual and where like auditing is such a kind of core function nowadays of smart contract code, a fun little anecdote for me would be that Ricky probably mentioned to me all those years ago and said, you should just learn Solidity. Why don't you just like review some of these early sort of bits of code that are getting put together? And I was like, oh, it's a long time since I did any dev work. Like, I'm not sure this one's for me. But I guess now I've kind of come through to it in a slightly different guise. So I got into crypto, and for me it was all around the blend between the computer science and institutional adoption from the sort of clients that I would have had in the past, from hedge funds through to pension funds and others. And so staking as this core primitive, like you mentioned, various primitives in DeFi, but just thinking about this staking yield as this thing that like staking is this proof of stake consensus. It's the way that you can coordinate a blockchain. It's how you're decentralized. And at the same time, you can package that up into something that looks pretty attractive to an institutional audience. It's like, hey, this is a yield that you can't get from any other source. How about it? Are you interested? So that's what got me into my kind of full-time career in crypto. As a business called Stake, they got acquired by Kraken. So that was a pretty cool ride, like joining a rocket ship like Kraken. Got great friends from there. And then kind of carried on the staking journey a little bit before I was at ECC Brussels about a year and a half ago. And with my buddy, we were chatting, and I just thought, okay, staking's getting pretty commoditized. There's a lot of polished, big enterprise-grade institutional players here. What else is there as an opportunity? What else can I set my sights on? And it's kind of rare to find a part of crypto that is underserved. There's lots of protocols all competing for the same attention, the same TVL. There's lots of L1s, L2s, various things we could look at here. And then you look at insurance as a sector, and you're like, hey, do people even know you can get coverage in crypto, or do they just think you've got to be degen and you got to risk it all? So that's the beautiful thing with Nexus Mutual is we look at it from that risk perspective side.
Well, it sort of begs the question now. I think for some people in the audience, they are degen and they haven't heard of Nexus Mutual. Maybe you could take us through at a very high level, like what Nexus Mutual is and what you guys offer.
Sure. So when I try and explain it to clients at a sort of one sentence just to capture their attention, I usually start with saying, most people have heard of the Lloyd's of London as this insurance marketplace. So in a much smaller, less grand scale, think of Nexus Mutual as the on-chain equivalent of the Lloyd's of London, in the sense that we're a marketplace for risk mitigation and risk transfer. So essentially a protocol that allows like an online meeting place for people that want to offer coverage, the equivalent of insurance, where they earn a yield by underwriting that coverage, and so they get a steady stream of premiums paid to them for doing the underwriting. And then on the demand side of the marketplace, you have people that are looking to get coverage, and it could be anything, right? As long as you can model it and price it, it could essentially be anything sitting on the protocol. But where we've really got strong product market fit has been in the crypto, what I call crypto idiosyncratic risk. So that's smart contract risk, protocol risk. A protocol can be to do with smart contracts. It can now, more than ever today, can be around oracles. Oracles are really important. People have underestimated the risks associated there. It doesn't just have to be on-chain risks. It can be off-chain. So it can be custodial related. So often people don't realize that Nexus paid out significant sums during the FTX bankruptcy, had a number of funds that were clients that possibly wouldn't have made their quarterly redemptions to their investors that got freaked by crypto and wanted to withdraw and pull out capital from the funds, but it was some of that would have been locked capital on FTX, so they had a duration mismatch, and instead they could get a payout from Nexus for that. So we've underwritten essentially like $6.25 billion now of cover, and paid tens of millions in claims. And obviously then for like our supply side LPs, they've earned millions in premiums through the course of that. One important bit I should I guess mention, just so we're really clear and unambiguous on the podcast, is Nexus isn't a regulated insurance provider. We're what's known as discretionary cover. So that's why we're called that's why we're Nexus Mutual. We're a mutual because it's a discretionary mutual that exists as a DAO, and you become a member, and by becoming a member, you get to participate in this risk transfer.
Yeah, it's interesting when you talk about product market fit. I mean, it's great when anyone from a protocol uses that term. I mean, it tends to be a very, very good thing. But if you kind of cast your mind back to, there's normally some trials and tribulations on the way to achieving that PMF. Why do you think it's taking so long, kind of, for risk markets to catch up with DeFi's growth and for insurance to even be a sector?
Yeah, it's an interesting one because, you know, from our perspective, even though I've only been with Nexus for a year, the protocol's been around since 2019. That's more than 6 years of track record now. I mean, I was talking to a traditional insurance guy yesterday, and they do some specialist underwriting cover in crypto too. And they've been around for a similar number of years as a company. And so the traditional insurance guys look at you and say, only 6 years, you know, you need like I don't know, you want to say like been around for 100 years.
You did say Lloyd's of London.
Yeah, exactly, right? So I think like this big thing is awareness. So hopefully just by being on the podcast with you guys, right, like we're going to spread the good word and people are going to be made more aware. Unfortunately, it seems to sort of take events, dear boy, you know, for things to happen. So, you know, maybe we'll come on to this a bit more later in the pod, but like, you know, balance of E2 hack, that was just a few weeks ago. We offer coverage for balance of E2, or we did offer coverage for balance of E2. Do you want to guess how many people had coverage for balance of E2 with Nexus Mutual? Unfortunately, at the time of the hack, it was a big fat 0, right? So we'd had people buy like millions of cover in previous years. But you know, this was one of those really, really sad and unfortunate events. Like one of those protocols that everyone just viewed as too lindy, too long-lived, too secure to need coverage. And obviously, like they did everything right. Like our hearts go out to everyone affected. Balancer team, great team. They did, you know, good sets of audits. I think on frequent intervals when they had big changes. And you know, generally everything seemed really sound, and we priced it accordingly at lower end of the risk spectrum. And yet, you know, I thought it was really important, like the way that the Ethereum Foundation have been pivoting towards embracing DeFi. People have often felt DeFi has been left out. Now they're embracing it. Vitalik's recent article, thought leadership on, you know, safer DeFi. But it's not no risk. It's lower risk for some of them, but not no risk. And it's just served to sort of bring to people's attention. And I was on a panel in Buenos Aires, and I was like, oh, I'm going to sound like an idiot for saying this on stage. But I was getting asked similar stuff about this, and I said, listen, I think crypto and DeFi has got to be less dog. What do I mean by that? Like, I have a Hungarian Wiesler dog, and he loves going around sniffing in the forest, looking for things. As soon as he spots a squirrel, he can't think about anything else, and he's just, boom, he's off into the forest chasing this thing, and he never catches them. That's an aside. But, you know, like, it's a squirrel. And for me, the placeholder there is yield. And people are just like, yield farming, chasing after the yields. And there isn't a proper consideration for risk. I don't think it's fair to categorize everyone as degen. Been having big, broad conversations with all manner of people, like vault curators and everyone in the industry, and I think we're kind of agreed at this point, and hopefully it will last rather than sort of like a binary attitude in crypto of like no risk, all risk. It's all, hopefully we kind of find a middle ground where we bear risk in mind. Like it's sometimes hard for people because trying to measure risk across and make sure everything is kind of measured so you can compare it properly. Sometimes people find it hard to have like a proper unit of risk measure. You can dress this stuff up in different ways, but the fact there are a lot more people now doing risk ratings, I think it is because institutions are coming and the types of institutions that are deploying, they don't care for the super high yields, but they need to know that their capital will be preserved or safe. And so I guess where we sit in a unique position at Nexus Mutual is beyond ratings, we actually put skin in the game, or our decentralized community does, our underwriting LPs. They put skin in the game by saying, this is how risky we think this is. You can compare all the different protocols that we have. You can have something like that's been around as long as, say, Uniswap v3, and you'll only pay sort of basis points risk for it, through to Hyperliquid is really popular with a lot of our clients. But they know it's risky, and we can charge 8%. It gets charged 8% because our underwriters feel there's certain material risks there. But at least you know, and then you can measure against like the yield that you could earn, and does it make sense? And there was a great tweet. Just I'll finish on this one. There was a great tweet when all the stuff happened with Stream Finance, and basically my head of product and risk was like, "We're not touching Stream Finance. It's a hot bowl of risk. Can't understand. Can't get to the bottom of it." We had some funds ask us if we could underwrite it, and we just said, "Listen, sorry, we're not. Our underwriters aren't comfortable. Plus, we don't even think you should be going near this." And then later on, like after it happened, it's not a "I told you so," but we had like someone in like who knows the Nexus sort of put out a tweet saying, "Listen, if they're not willing to underwrite it, but more so if the price of the risk, to buy coverage from Nexus is in excess of the yield that you can earn, just don't deploy," sort of thing, right? Like, so.
That really begs the question. Like, I'm curious. Like, what would you say your distribution of users would be? Like, would it be regular users like myself? Would it be like protocols, funds, or just sort of an interspersed mix of them all?
Yeah. So I think we're around 10,000 members in the DAO. So that's everyone from buying to doing the underwriting. So the vast majority are on the buying the cover than are supplying the capital to underwrite it. And like, that's people that have been around with the protocol from the very early days. And so it's people that were like complete DeFi enthusiasts and tinkerers. But what's increasingly happened is the vast like amount of like a sort of Pareto 80-20, like a majority of the revenue is now coming through from like a more sort of curated set of bigger names. And it's funds that I can mention publicly that people might know in the industry would be like Dialectic, Edge Capital, Fasanara. And so these are guys that are deploying in pretty considerable size in DeFi or broadly on-chain and off-chain risks. And they have like a risk committee, and they have like really thorough due diligence at the start of their investment process through to what they do when they deploy, when they're monitoring on-chain, and what they do in any kind of like post-incident events. And they've also got like a wider sort of maybe like fund setup where they have to report to their own fund auditors and the like. So they go through all these steps, and so they're always looking for opportunities. They're very, very shrewd at that, and yet oftentimes they're like do it where they package a coverage from us. And what we've done is like as DeFi has evolved, because it's just got so complex now, right? Like I find it hard to keep up, and I'm in the industry. I imagine you guys do a little bit too. Like you know your own protocol really well. A select set. Trying to understand everything, it's really hard. And so the I guess the rise of the professional risk manager, like people, the vault curators and the like, in that regard, those are the guys where we have significant demand, and we see it becoming like an order of magnitude bigger over the course of the next year.
If we look at the complexities of buying coverage, and when I say complexities, I mean it sounds relatively straightforward, but to give a kind of IRL parallel, we all know that you always have that fear that you bump your car, and some guy comes out and has a look and says, "Unfortunately, there's not enough air in your tires, and your policy states." I wondered how simplistic and does it take a PhD in law to understand the cover I'm getting, or is it simpler than that in terms of which risks are actually covered?
Yeah, definitely doesn't require the PhD level. You do need to take it. This isn't something you can just like one click and go. You do need to be reading the coverage terms. Like we put it really center and front for all the different coverage that we offer. Each one can be pretty unique. Every protocol is unique. So we have kind of like this core offering. So if it's a protocol, we'll call it protocol cover, and that covers you against the smart contract hack. It covers you against an oracle manipulation. It covers you against governance attacks. There are explicit exclusions. It excludes a front end attack. So just recently, I'm forgetting the name now. There was a protocol that had a front end. We can't cover that. It's just like it would be too expensive from the perspective of our underwriters to manage a risk like that. So we made these exclusions. Then there's like a traditional insurance policy. There is like a full cover wording and terms. My shout out to my head of legal, Anya, who works on that relentlessly because she has to keep up with the pace of the things that we're doing. We're always releasing new products. We've released DPEG covers, for stable coins and other pegged assets. We're now doing leverage looped DPEG covers. It's like it's a mouthful just to say it, and it's very complex. So we don't recommend like a retail user in this instance buying it without coming and speaking to the team, and even the funds that we're selling it to. We go through quite a lengthy process of like Q&A, and like we'll build out an extensive FAQ because there's so many different scenarios. And so you've got this like base cover wording, and that goes through all like details and a sort of relatively extensive amount. But we don't want it to be overwhelming. And like what we've got that's really cool, okay, versus I think, your example here with traditional insurance policy, and you're not quite sure, and there's this like 30-page super fine print, is everything we do is really highly transparent. That's the beauty of doing it on the blockchain. So Hugh, our founder, he's a traditional insurance guy, came from Munich Re. He's early into crypto and Ethereum, just saw the power of blockchain to coordinate, and just thought this is a great way to you can bring like insurance to the masses by mutualizing. And so on that basis, for the mutual's benefit for everyone in it on both sides, transparently, you go to the UI of Nexus Mutual, you can see all the risks that we're whitelisted and covering. You can check the price right now. You don't need to like call a hotline, phone someone, then tailor a policy, or go to comparethemarket.com and like have to like fill in all these different forms all the time. You just get it direct from us. You can go straight there. So that's on the initiation side. Now when it comes to claims, like it's the question we get all the time, like how do I know you're going to pay because you're not regulated cover, right? We are a discretionary mutual, so the mutual has the discretion to pay or not, but we have expert risk assessors. And you got to stick to the cover terms that you provided. And then in addition, for every claim that we've ever had come to us, it's logged. So there's not everything's on chain, but like all the covers are on chain. The claims, we have a fully annotated spreadsheet with the full history, and so you can look back through all of that and just get a feel and confident, given our track record, of like how we do things. And you can always come and speak to the team. So we're not just code is law. It's not just the sort of protocol existing out there in cyberspace without there being people that you can get in touch with. We have a customer support, essentially like helpline, and you can look at those claims and you'll see like, okay, this is why they paid and how they did it. Rejected claims are often because someone bought the cover after the hack. That kind of doesn't work out so well. So.
Just a quick irresistible follow-up, because crypto Twitter this week has been absolutely full of tether FUD / not FUD, and you mentioned stablecoin DPEG insurance. Yeah, I wondered, what your take was on the tether backing and how that might play into how you price cover there.
I don't think any of the news is going to materially affect. We do offer like a USDT0 DPEG cover. I mean, I think it's there. We wanted to test the water to see if people would be interested in it. Where we're getting significant interest on DPEGs is more like yield-bearing stable coins with some interesting strategies underneath them. And so we've had a lot of pick up an interest from funds that are LPing into these yield bearing stables. So and I haven't, like, to be honest, I haven't had enough time to dig into all the material that's been out there. It's sort of interesting how it's cropped up at this point in the cycle, let's say. So
I was actually curious just about speaking of the depegs. I think USDE depegged like quite substantially during the October 10 flash crash.
Yeah.
Did you have anyone ask about that? Because that looks like it could have been pretty bad at some point, but thankfully it all sort of got smoothed over.
Yeah, so we have two types of DPEG products here, getting a bit technical. We have like our classic DPEG cover, which we do for people that are like holding a pegged asset for like a longer period of time. And so that's really neat in that, in terms of understanding how it works, rather than it being a protocol cover with a smart contract hack, and there needs to be a post-hack analysis to understand like what's actually gone on. With the DPEG, it's not quite like what people would term parametric insurance, but what you can do is say, okay, using this reference source price, did the pegged asset depeg by X% over X period of time? And we do this on sort of like let's say 10% over several days. And if that occurs, then this pegged coverage kicks in, and you basically swap you give us the pegged asset, and we pay you out the difference of whatever loss. Maybe it dropped to like 65%, so you get 35% payout less a deductible. So what's interesting with the Athena USDE, everyone suddenly really started paying attention to oracles, right? Like, is it hard-coded fixed rate oracle, or is this a market-based oracle? And if it is a market-based oracle, from where is it deriving its data, and how sensitive is that market to flows? And obviously with Binance, because they were doing it inside them, if the market dried up, it kind of caused carnage. So our DPEGs are typically for DeFi rather than for a specific exchange, and you wouldn't be able to buy USDE DPEG cover from us blanket wide across any venue. It will reference a specific area where it's valid. So it'll be valid on DeFi protocols, on chain. We could construct the one that would have covered someone for the Binance DPEG. It's just like, you'll be paying. Our guys are smart, quantity. They go into everything, and they would know that, okay, all right, this is going to be someone that wants to buy this. It's going to be in market distress, and it's using Binance's in-house oracle against their own USDE price rate. That has a material impact on the cost of cover, right? But what it did do is, we didn't have anyone ask for it, and we didn't have that coverage there. But it did sort of focus minds on people understanding like, what are the sources of potential triggers here, and similar today, what's happened with Stream Finance. So we've only just released this product called leveraged DPEG cover, so allowing people that want something that, rather than it being X% over a set number of days, if they're doing like a looped strategy, which is kind of common now, pretty common strategy inside DeFi, then you can get knocked out of that loop if the asset you're looping depegs too much. So we've kind of like taken months of hard work. I've got to give a shout out to my product and risk team. We've now essentially built this product that people can buy this cover to protect them in the event of that kind of like extreme market scenario occurring.
Just curious from like the quant side of things, like how do you guys like set prices? How do you set like coverage limits and all of that? Is there like some actuarial basis, or is it some quant model, or is it just pure market determination?
So I'd almost break it down into sort of two steps, which is, like for a brand new cover listing that we provide, that'll either be like a number of users in the community, or it can be a fund coming to us, or just something that we've spotted which we think will be of interest to the community to get cover. Then we essentially start a due diligence process to whitelist that particular cover listing, and that's like where my product and risk team get involved, and they start going through kind of like a bunch of things you'd expect them to do. Like, okay, it's a protocol. Okay, who is the team behind it? What's their track record? Okay, what's the quality of the code base? Are there publicly available audits? How much might we need to audit ourselves? And on, where you break it down to against all the this could have when the guys started this, it was a proper, I think, sort of exercise of like, we've just got to guess here, right? Like, we'll just put some money on the table, but do that in an intelligent way where you're like hedged, you're not getting overly concentrated in certain positions. And unfortunately, some of the other sort of insurance type protocols that have been around, they just got too concentrated on certain risks. 2022 was a bloodbath, and they had to pay out way more than they had as capital, and their loss ratios were like well in excess of multiples of 100%. So you just like blow up and die. My team, credit to them, have always been like able to price stuff so that it makes commercial sense for the right type of user, but at the same time, done it in a way that we're controlling for these significant tail events that can occur in the industry. So yeah, you end up going through that whole sort of first stage process, right? And then at that point, it gets listed, and we speak to our underwriting LPs. So like, hey guys, this is kind of like something we're happy to have as a risk. Are you guys comfortable? And so I wasn't there during the sort of Nexus Mutual V1, but originally I think everyone used to offer the same price no matter which pool you were in on the supply side. Whereas now it essentially works like the V2 that we have is like a order book, and each pool has a pool risk manager, and the risk manager says, okay, I'm willing to underwrite $2 million of Aave, $1 million of Pendle, etc. And I set my price levels. And so when you come to buy the coverage from us, it essentially matches up across 3, 4, however many pools it needs to get you the best weighted average price for the side. So once it's listed, essentially, the underwriting LPs, who are in their own right sort of risk experts, they can set the prices that they want. And there's a degree of like wisdom of crowds and a little bit of like following one another, but also people are set to sort of can choose to win business and sort of set a slightly better price if they want to have a bit more exposure to that risk to earn yield.
So if I'm a user, it sounds pretty straightforward, honestly, which is very much a good thing. I go look at the protocol I want to interact with, and I type it in, see if you guys cover it, and if you do, I see what's covered. What about on the other side of things? Who do I have to be, or what do I have to do to set up a coverage pool?
Yeah, so it is essentially that anyone could set up a coverage pool. I guess with the disclaimer that you've got to become a member of the mutual. So we go through you connect your wallet, you go through a lightweight KYC, because unfortunately there's a few countries that don't allow for this concept of like a mutual. So if you're unfortunately like in China, India, a few other places, it's about a handful, you can't participate. Okay, if you get through that first step and you can become a member of the DAO, you pay a really small fee, like 0.002, I think like about $10 less than as a membership fee, and then you're in. And then you can basically go through the dashboards and choose what you want to do, from buying coverage to supply, like depositing ETH to mint our NXM token to put it into a pool. And like essentially, yes, anyone could run a pool. I wouldn't recommend it. Like one of the best things to do is always baby steps with this stuff, right? But what you can do is say, but I think this is a nice way for me to earn yield. You can look at the performance of all the different pools that we have and see who's, might be pseudo-anonymous, like the person that's running it, but you can see who's the pool curator themselves. You could allocate to a number of different pools. And then as you got more comfortable with this, you could then choose to do it. And I guess like going back to the Lloyd's of London analogy, in Lloyd's you have syndicates. Syndicates exist within the Lloyd's structure. So we call it pools or staking pools because that's sort of familiar lingo for people in crypto. But when I'm explaining it to traditional finance people, I'd say like, you could literally build a syndicate here if you wanted to. Like Nexus gives you the capabilities to supply whatever size capital you want, and then to choose to underwrite whatever risks that you want that we permit within the protocol, and away you go.
Yeah, it's interesting that you say, anybody could. I'm not sure I'd necessarily advise. That applies to a lot of DeFi.
That's pretty much all of DeFi, right?
Providing liquidity to Uni V3. People thought they were experts with concentrated liquidity until they tried it to offset impairment loss, no, impermanent loss, sorry, and very quickly realized they weren't experts at all. So I still think that it has the same or similar draw, to my curiosity though, to think, well, there is one thing I've really noticed in crypto, even from the beginning, but certainly even more in the last year, is I love real business. I love it when a crypto actually has a revenue, a protocol has a real revenue stream and real cost and real customers and real profits. So I think what's nice about that is you can use kind of established business logic and math to kind of look at this and say, okay, this is the kind of coverage demand signal and this is the returns that have been had. This is the level of risk we can adjudge. I think that's way more appealing for someone seeking yield than, necessarily dropping into a vault where you're not exactly sure where the yield's coming from.
Vault plus points plus, I mean, the sort of Sam Bankman-Fried, like, you can do this magical thing with this box and you can put money into it and then money comes out again, sort of things. Yeah, look, I mean, it's great to hear, Ian. Like, from our perspective, like, what we've done is essentially build all these components of like an insurance company or an insurance marketplace, and then like for a long time, as the guys are building out, like providing transparency, and I've mentioned that on a couple of bits of it. We have all these June dashboards, so you can essentially come onto the June, but you can see every cover that's been purchased. You can see all the premiums are coming in. You can essentially take all the stats of the protocol and turn them into like all the measures that you might want to do that you could for comparables to a traditional insurance company. Whereas most of the traditional insurance space companies, you don't disclose this. If you do, you file it, maybe public company quarterly. This is live. Like, that's quite a challenge for us to have that see through, look through. Everyone can see what our capital pool, like total amount of capital is, how much we can therefore underwrite, all those sorts of elements. But we think that brings really significant power to what we're doing, and we're hoping, we're the first, and we're hoping to remain the leading sort of platform for this, and very much welcome others coming to build with us. So just give a shout out to a team, OpenCover. They essentially act like as a syndicate for us. They do some really cool tech integrations for us. So we have protocol. It's not just from like individuals or funds that use us, right? Like, it's protocols too. And my head of products, like, it'd be really good if products came to us before they get hacked. Like, just shout out to all the protocols. Get in touch with us before you get hacked, because then we'll give you a much better price than if you've been hacked. But like, we have a lot of people coming to us, like smart savvy teams, and they're like, okay, think we've done really good build out, but it'd be great to get like Nexus Mutual's essentially a stamp of approval, and just like people to know like what you guys rate us on a sort of risk basis. And I have these, I both want to offer it to my retail users, but I have certain large LPs that will like probably bootstrap me quicker if they know they've got Nexus Mutual cover. And we can kind of get all of that in place for people. So
oh, awesome. I had one quick question about like, I don't know much about insurance business, right? But I'm guessing that for insurance,
I didn't either actually before I joined Nexus. I'm not an insurance guy. I didn't feel like I was an insurance guy. I still don't. So it's okay. We can all admit it.
I'm guessing like the business model is like you receive premiums on like a consistent basis, and then eventually like there's, unfortunately one big payout day, right? And the idea is that the expected value that you get from those premiums should, generally overshoot how much you'd have to pay out on like the bad events. I was wondering sort of like, what would be the main reasons you guys have to like pay out, and like, could you sort of say like roughly what the distribution would be? Like you mentioned oracles before. Is it primarily oracle stuff, or is it smart contract hacks or other shenanigans?
Yeah, it's really fun actually. Like our marketing guy, I think towards the end of last year, just to show how far we had come, came up with this really great graphic timeline of everything that's happened from the inception of Nexus Mutual through to kind of like the key things, like some of the build out that we've done, like V1 to V2 or whatever. And like different, like when we added slashing insurance cover for stakers and the like. But it also, like, because I used it as a reference guide, because I was like, I know some of this stuff, but I haven't been in the team for long enough to know all the hacks. And obviously like 2022 was just the year as well for like the industry just going into crypto winter. So like, yeah, that logged all the kind of like, so, Nexus almost came about as an idea from Hugh because of like the DAO hack. That's kind of almost like seminal in our lore and mythology, is like, where we come from, and then the white paper in 2019, and then like we've got a mix of things between various like classic smart contract hacks, like something like the Cream exploit in 21-22 period, various others, and then you've got stuff like I couldn't rank these all now by the millions of dollars that have been paid, but FTX would have been a sizable one just because it was so seismic for the industry. Euler's V1, that was a substantial one. Although, the interesting here, like when you have insurance, it's not just about initial loss. There's also might be things that can be claimed back, and if a protocol can recover value itself too, then there's like a redistribution. And so that Euler was a very interesting case there. And we go through to sort of past couple of years, things were quieter 2024, and then everyone's like, oh, it's all safe now. And then we've had obviously what just happened in the past month, but we had things like I'm gonna forget the name now, but there was a hack of a protocol just a few weeks a few months prior, and we paid out a few $100,000 in that. So I guess one of the things we do is just make sure that we're very hands-on with our cover holders that have claims, to help them get paid, to make the right claim assessment when they want to submit and get the claim. And then we're also trying to do a service to the industry and say to people hey, we've paid out this X million or 100,000, whatever it is, so people are aware when these bad cases happen, there is think about the next time you're deploying, how you might not, you don't want to feel caught out. You can get the same safety that these other users have had. But the key thing here, I guess, from what you're asking as well, is around loss ratio. Yes, we need to earn more premium, and along with the premiums that we earn and the overall capital pool that we have, where we can essentially invest some of that in low risk investment strategies. For us, the equivalent an insurance firm might invest in certain different duration fixed income bonds. For us, we can put ETH into Lido and other sort of stake strategies as a lower risk of DeFi, and so as long as your premiums earned plus those investment returns are in excess of your loss payouts, then you're going to stay alive, and that's what we've done. I mean, I don't have the stat to date at the moment. It's not a number I've computed recently, but I think a little while ago we had one of our investors do it, and they came out at about a loss ratio of about 50%, which is pretty good, really. I was checking this on what traditional loss ratios can be in traditional insurance, and so varies by whether it's life insurance, health cover, car, but you can have things where it could be 80%, 90% in health. But as long as you're below 100, you're fine, right? And you keep on earning. Whereas, like I mentioned, a few other protocols that maybe we're building out, it's not good reading. It looks like their loss ratios were 300%, 400%. Obviously, that just unfortunately put a stop to what they were doing. So,
if I think of the parallels to not only kind of car insurance, but thinking about assets that we try and insure IRL. I don't know that there's a direct comparison unless you're an institution, really. This feels like it should be a really smart solution for larger capital whales, as DeFi labels them, and institutions. Because I think for pure retail, we've seen from their risk appetite with things like leverage and perps, it is that kind of degen culture when you're playing with, I don't know, 100 to 1,000 book account. So I wonder, is that kind of a target demographic? Are you kind of trying to be the for everyone insurance solution, or is it more catering to kind of larger capital where the risk is higher and therefore it makes sense to offset some of the yield with the premium?
Yeah. I mean, I think with the rise of vaults in DeFi, you're getting even though DeFi is meant to be permissionless, you are getting intermediaries coming in and saying, hey, you can trust me. I will create a strategy for you, and you can earn this amount of money. Leave me to worry about stuff of varying degrees, right, and of varying success. Like if you look at the stream finance thing, but so we're seeing really considerable demand from essentially that portion of the DeFi ecosystem. It makes sense, right? Like these are the risk manager guys, and they want to look good, and so they need to come up with attractive yield strategies, but they also want to know that they're both are managing risk correctly, and that they can show their potential users and depositors, which could be again anyone from retail through to institutional for them, that they're managing this correctly. And so that's a sort of nice fit and distribution model for us.
Speaking of models, I guess you guys have a DAO structure. So you mentioned before, like you have the Nexus Mutual token. Can you maybe step us through sort of what that entails? Like how does that interact with things? I mean, we get that question a lot at Derive as well. So curious.
Yeah, so I think, as I said, we're a discretionary mutual. So that kind of aligns really nicely with this concept of DAO structure. Everyone that joins actually has some voting power, even if they weren't to mint NXM. And then and when you go to the token's there for sort of incentives and the representation of our capital pool. It's a governance and utility token. So you contribute, people that on the supply side contribute ETH to the underwriting pool, they receive the NXM, and that NXM is backed by the assets, like that ETH in our capital pool, and then the NXM is put to work to underwrite and generate yield. So, and then what happens is as well as like you can be actively participating in that underwriting process through the pool and staking your NXM, but just even if you just hold NXM, anyone holding NXM, half the there's a proportion of the value from the premium that gets shared across NXM holders as a whole, and on that basis, essentially like the more covers we're underwriting, the larger the capital pool, the token value rises up. So it's kind of like a fairly attractive investment model. And then we also have this thing that got brought in the V2 called the RAM for ratcheting AMM. And this is like essentially like our price discovery module. And it captures value as some members redeem the NXM to turn them back out, take it back out into sort of the assets they had before, like ETH. And so, essentially NXM is this orchestration. It's a token that's an orchestration incentive layer, and it ties all the kind of core processes in the mutual together, where we're a mutual, we all share risk with one another, and we all benefit hopefully with value accrual together over time, provided we make sure that our claims are less than the total cash flows that we have coming in. So, but we covered that already. So.
If we take a worked example, we mentioned a couple of times the different things that have happened over the last few months, but balance of V2 as a worked example. Could you just walk us through it from the Nexus Mutual side of kind of as it happens, when do you react, how do you react, what is that process?
Yeah, so, we will always be monitoring for, we're very plugged into the security community, actually work a lot with the auditors, the bug bounty hunters, the on-chain monitoring platforms, but like we'll still only like learn of an exploit in real time like everybody else. So I guess when news breaks, then the team jumps into action to identify like, okay, is this a real hack? What are the initial findings? Do we have any cover holders for that particular affected protocol? Are any of them in scope? Okay, we then typically, like, there weren't any for Balancer, right? So we didn't have to go through that. But what would typically happen is it says in the cover terms, we go into essentially like a 2-week cooling off period because a lot can happen post hack. And so in that sort of 2-week period, it can be the analysis that's taking place, the war room that the protocol has, and the sort of debrief and post hack analysis, combined with someone offers a bounty and the hacker returns some of the funds. Like a lot can change. And so by sort of at the end of that 2-week period, we typically have everything in place where we then have reached out to people in the interim too to say, you're affected, give us some more information on your wallet. So, we have a few questions. All right, here's what you need to do to submit a claim to us. And then rapidly we go through the claims assessment process. We have these expert claims assessors. And then typically a few days later, right, a payout has been made. So I'd say that's it's not overnight, but it's pretty relative fast turnaround. What's been really nice, say, with the stream finance is we weren't underwriting it, didn't cover people directly on it, but it had some contagion and it spread through to a few other vaults. So we had a handful of users that were impacted, and our cover terms still allow for that kind of contagion impact. And so they got paid, and there was I don't know them, but there was a few people that sort of gave it. Not a testimonial because we didn't ask for it, but they were just like, I got a payout from Nexus Mutual. I'm really happy I had this cover. And it's just really nice. It actually is really nice to have people say that. You're like, oh, in the way that Ian, you were saying, it's nice when a protocol has real revenue. It's nice when a protocol has real revenue, real users that has real benefit for them, particularly when it's something as bad as a hack occurring. So it gives us a soft, warm feeling inside.
Absolutely.
How do different users view smart contract risks? Because I know some users are super turned on to that, and they read all the audits, and they care about the different audit tiers. Sort of what's the spectrum of people that you deal with? Is your typical user who uses Nexus Mutual, are they generally quite worried about smart contract risk, or are they more worried about the peripheral stuff like you described?
It's hard to say in the sense of it's not a homogeneous set of people here. We've talked about how many different actors we have, from retail through to funds, and a lot of people. One fun thing that happened to me just a few we're even finding funds that have used us without ever coming and reaching out to us. They've just been buying cover through pseudo anonymously. It's just their wallet address. We know nothing more about them otherwise. They haven't come to myself and my institutional team to do anything bespoke. So often we don't know who these people are per se. So I'm making some assumptions. What I can tell you about is the people that I do talk with quite regularly, which are those larger funds that need some customized bespoke. There's something we call fund portfolio cover, when we put together a bespoke package of not just one risk, but 20, 30, 40 risks in a portfolio, package it all up together. So it requires a dedicated pricing that we can't just directly list or automate on the front end. So, for those people, risk is front and center. They'll be going through their own sort of due diligence. We can often share due diligence findings with one another. These guys actually even sort of they'll be like, oh, I want to look at this protocol, kind of, here's some info. They kickstart the process for us, help us out, speed things along. But I broadly feel the people that are using Nexus are the people that are risk aware. They might not understand the risk fully. They're coming to us as experts. I feel it is shifting from just it's true. The stats do bear out that smart contract risk has lowered, and as has pricing on Nexus Mutual. So what you used to have to pay for cover on Aave, it's a lot lower now. And I regularly have this when I go to conference, that people are oh, but price was a little expensive back then. I mean, maybe yields have come down too. They have. But we're okay, we don't price off yield, but given the track record or the perceived security and safety versus the regular check-ins and analysis we do, this protocol is that much safer. We can price it this much lower. That's why I was mentioning Uniswap v3 now. We have it in it's 50 basis points. So sometimes I ask people guess what you think it will cover for something, and often they are surprised that it can be cheaper than expected. They might not be with Hyperliquid, like I mentioned, it's higher, and people maybe know Hyperliquid, it's so popular, so ubiquitous. Maybe they don't necessarily realize some of the risks inherent in it, So anyway, so smart contract has come down, and so it is more peripheral. It's sort of like Oracle risk that can kind of have the knock-on effect. It's kind of some of the contagion pieces within vaults, and we're always looking to innovate, right? Which is why we've done the DPEGs and the leverage DPEGs. We look at essentially we say to people, what keeps you up at night? What tell me a risk that you can't manage yourselves. I mean, if it's a market risk, I say go do you. like that's your choice. You have to like buy put options or whatever strategy it is with the price of things. Like we don't do that. But if it's a risk that you can tell me like you're concerned about and we can quantify it, then we can do it. I mean, like to kind of go left field here from like having just spoken about DeFi, given the spate of wrench attacks and things that are happening to people like physically having their crypto taken off them, we're in the process of working with some like top end team where we can essentially offer K&R in the industry, but kidnap and ransom cover essentially. So you know, like if you're an exec at a big company like Coinbase or whatever it is, you'll have security, you'll have insurance and coverage. If you're a large crypto whale, you probably don't know where to start to go and get cover for that sort of thing. Like Nexus Mutual can be a starting off point for you for that, and you can pay in crypto. So.
Is it just expanding the thought? And I don't know if you're probably already thinking about this, but is there another? If I kind of look at the potential customer base or the buyers of the product, we talked about users, we talked about LPs and kind of coverage pool creators, but other protocols too, right? Like if Sean and I are out talking to a whale about market risk or market opportunity, how integrated might you be in the future with, you know, because we often hear, well, smart contract is still a risk, right? You're talking about hedging, that's great, but what if the whole contract gets hacked? I wonder whether, you know, are you trying to integrate onto UIs within protocols? So it's kind of like, here's the market risk, but also here's our audit page, and you can even insure this if you wish.
Yeah, I mean, look, I'm working regularly with protocols. We have integrations with the likes of EtherFi. I mentioned OpenCover. Those guys have put us into VFAT and other protocols. I mean, I think when I met Sean we'd had a couple of beers at a party in Singapore. The music was very loud, so we couldn't really talk. But I probably otherwise would have bent his ear a little bit about how we have like had really significant institutional demand for cover on Derive, and that doesn't matter like on like how good Derive's, like you guys are good, right? Like you've done really good. Like the price that we underwrite you get reflects that. But certain risk actors don't want to LP unless they have the cover. And I think we had one cover where it was like $10-20 million of Bitcoin, which is really chunky, and they were deploying into Derive, and they bought the cover simultaneously. Well, they bought it then on the Nexus site because we don't have that UI. But let's put a pin in that. We should go get the UI added in on Derive. But that works, and I also work with various other teams that are sort of offering yield opportunities to people, and they're now more than ever working on kind of like risk frameworks, because they don't just want to present like a smorgasbord menu of here's the highest to lowest yield. It's got to be like, what's the risk adjusted yield? And here's the risk framework that I've built, but I also want to go to third parties. I could go to like Redstone and Satora now for their risk ratings. Oh, I can go to Nexus Mutual and I can get a price. Oh, and I can actually not just look at the risk, I can buy that now as a tangible thing.
Very cool.
Awesome. No, I'm cautious of the time. I really just wanted to get a few more. I just wanted to hear your thoughts on the market, because obviously we're entering into a new regime. Obviously we had October 10, and that sort of has kicked off this. What some might say the bear market or the new crypto winter. Do you see us entering into that stage? Like, is the 4-year cycle holding true? I remember I saw a Twitter thread that pretty much called it to the day. Or is it simply just everyone's worried about rates?
Oh, this is the bit where I have to say this is not investment advice, right?
It definitely
really
isn't.
Loud and clear.
None of this is investment
also, no one should listen to me for an opinion on where the market direction is going. Like one of the, I used to I told you guys, like in my early days, I sat on like a hedge fund sales desk, so I was glued to my Bloomberg screen, looking at tick by tick movements, talking to people on trading ideas and stuff. I don't have the energy to do that anymore. I'm too old for that. So I have the luxury, like I look at price, but I don't look at it regularly, and I sort of do the like Nassim Taleb advice, like just turn away. If you're making you've made a strategy, put a stop in, but like just look away. Don't bleed yourself out like staring at the screen the whole time. So like the neat thing here is that we need to have an appreciation of price levels and where yields are, because that drives cover demand. Like the higher the yields, often the more correlates with purchases of cover. It shouldn't do, but it just does. That's human psychology and human nature. Like I think I'm like in the camp of not believing in the sort of 4-year cycle anymore. I think there's way too many other sort of structural things taking place now, but I couldn't pin it down for you. I can't call the bottom here. I feel like, you know, the 10-10 stuff happened, and we were on an offsite at the time, so I hadn't even thought to be like, okay, what extra, like, it just seemed to clear up so quickly, didn't it? Like after Binance is going to compensate everyone that's been affected, or a large majority. Forgot about like the contagion that was going to sweep through, and as it did, and it surprisingly then did, like, whereas people were like, oh look, CeFi blew up, everyone just had like, when the centralized exchanges can't cope with it, turn off the system, people get screwed. On the DeFi side, it was working really well, and yet now we've had it where it translated from CeFi into DeFi, and we're still waiting. And then it turns out that the problem in DeFi is CDeFi, or someone pretending to call themselves a stable coin when they're anything but. It's just like a on-chain, off-chain hedge fund. Word salad here. So I hear there's a lot of like legal activity going on as well, sort of try and get redress and various things going on between various actors. I don't think the story's over yet. I couldn't tell you exactly how it's gonna play out. There were, just rumors around like Market Maker or someone else that's been significantly wounded, and have they got the necessary capital to shore up or whatever. It does feel like the price action, as well as some like macro driven stuff, has just kind of come a little bit out of nowhere. So I guess like it's more I'm writing to Santa and wishing him to give us like some stability over Christmas, because I just like a little bit of time off, not deal with any hack. Hopefully no one gets hacked over Christmas, New Year period, because the whole team's been working really hard. We just want to sort of have our Christmas lunch and enjoy a bit of time with family and friends. But yeah, that's I guess take what you want from that as an opinion. Hopefully that's useful. But
I think the whole concept is awesome, honestly, Ralph, because it kind of gives me pride that the more that we're in this kind of nascent and growing industry, and the more it grows up and becomes sophisticated and credible, products like this really add to it. That when we're talking to institutional investors, these are the things they should and do ask. What are my layers of risk here? And they look through your legal documents, and they look through your treasury, and they look through, and smart contract risk is one of those that's just, you normally end up saying, well, yeah, that always exists, guys. Yeah, that's kind of part of the upside.
You've just got to make that decision. So if you want to do crypto, you got to opt in. Now, like the way I look at it is like there is risk, right? Like we're in the job of selling risk, as it were. But like I guess the reason you guys are in it, and why we are, is we all have this optimistic viewpoint that like smart contracts are the way forward. They do unlock so much better than the legacy COBOL code written TradFi. I used to work on one. It wasn't quite a tape machine, but it was like horrible scripting language that wasn't even like, didn't even have the level of C programming. I despaired as a computer graduate, like, oh my god, is this what I'm going to be working on for the rest of my life? So no wonder I kind of found my way into crypto. So I think it holds as a promise, but it's still like, people forget it's still so early. I mean, like I thought the Hasib article recently on like what do you say, believing like the defense of the exponential, right? Like you just got to sort of don't risk more than you can lose, be smart about it. And I guess my shout out to everyone will be like, think about buying smart contract cover. Like we're still early in the industry. All of this is heading in the right direction. Just avoid hopefully any significant blow ups. And yeah, like if you're smart about it, you can risk adjust, and you can still get meaningful yield in excess of a certain threshold that you might be looking for, but you can scale into it with, you don't need to cover 100% of your assets. Like you're unlikely to lose 100%. Like most of our funds don't buy 100% coverage. They buy a proportional amount. So it's all got, sorry, Ian, if I cut you off, but like that's kind of like, I'm agreeing with you. And I think like just hopefully adding a little bit extra insight there.
Yeah, not at all. Absolutely. I think we're completely aligned. And I think we keep doing this on podcasts of kind of arranging BD conversations for afterwards, but I really do think it empowers us with what we're doing, because serious capital only comes where there's serious protection. So
So
really fascinating to hear it.
if there's time, just one quick little mention I'd like to make
Sure,
is, like the other thing people often ask us is like, well, great, Nexus has been around for this long, you've been underwriting this amount, but like, how can you scale, right? And so we had a really exciting strategic partnership announcement during DevConnect in Buenos Aires. We are partnering with Symbiotic, so restaking protocol. If you think of us as like Lloyd's of London, an insurance market, then a good functioning insurance market needs reinsurance. And so where does the reinsurance come from? Well, restaking has that slashing mechanism, which is a nice way of redistribute. People used to think it's just to burn the ETH. No, you can redistribute it. And so you can basically get significant capital. Like there's billions and billions of dollars of restake. I don't think all of it's going to come, right? But there's billions of it sitting there, essentially idle. It's had incentive points, and now it's a kind of like crux is, okay, we've got to find real use cases so the capital stays locked. What are they? Insurance and reinsurance is this great use case. So we've been talking to we've known the Symbiotic team, as we do the Eigenlayer team, for a long time. We've been talking to them about this, and it's sort of like hitting a tipping point now where I have people on the buy side, demand side, wanting coverage in excess of like, I don't know, $50 million, like $100 million, but I can't write that because that would wipe out my Nexus Mutual's capital pool. So what we can do is say, okay, we'll be the first loss, and now the restate capital can get a really meaningful yield from a real use case, real yield, but as a sort of second loss. So it's not going to get hit initially, but it can provide this additional capacity, and that'll get us into like these $100 million plus type coverage, either on single lines or as like a cumulative thing across many people buying it, because Aave is really popular, Hyperliquid's really popular, various other things. So kind of just hopefully leaving your audience with something really exciting for what we're working on for 2026, and everything's vaults. So watch this space around how we're going to bring out stuff to do with like programmatic coverage on vaults, but I can't say any more than that at this point. So
really cool integration, and definitely shout out to the Symbiotic team. Really cool team, really cool protocol. We know them well.
Great.
Well, yeah, thank you for the time. Really interesting conversation. And yeah, if any users have any questions, where can they follow up on this, Ralf? What's the best way to interact with you?
Yeah. Well, thanks so much, guys, for having me on. I can't believe we've gone over an hour. That sort of flew by. I hope I wasn't just talking. I get told I can be a chatty man, but it's a fascinating topic. So really appreciate you guys having me on. Really, really great to be here. And they can go to the Nexus Mutual website, nexusmutual.io, to go and become a member and sign up, buy their first cover or deposit capital. You can follow me on X. My Twitter handle is Montblanc DeFi.
Very apt. All right. Well, great. Thank you for your time. And yeah, we'll leave it there.
Cool. Thanks, guys.
Thanks, Ralf.
Cheers.